afternoon, and welcome to AIABA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders as always. Everyone that has registered for today's program will receive a copy by early next week. And if you have any questions, feel free to enter them into the lower right-hand side of your interface under the Q&A bar. Now join me in welcoming back our good friend, Charlie Chesbrough, Senior Economist at Cox Automotive. He has a lot of important information, and I'm not going to take up any more of your time. So, Charlie, take it away.
All right. Well, thank you, Rachel. And thank you, everybody, for listening in today. Thanks for having me back. We're going to give you the update on what we're seeing out there regarding the virus. I wish I could tell you it was all over and the vehicle market's back at 17 million, but I don't have that news to give you today. But we are seeing a lot of interesting things out there. So we're going to give you an update on what we're seeing on the virus and where the market recovery is at. I'm going to briefly take you through a quick update on what's happened so far in 2020, and then talk a bit about what we're expecting to happen next, which is certainly the key question as to where we go from here. But let's start by talking about the virus itself. This is a map that's showing the United States and by county and where we've assessed the pandemic level for these different parts of the country. And what we can see here, and I think the big takeaway is that we're really not dealing with one pandemic. It's multiple pandemics, hundreds of little pandemics that are going on around the country. But on the whole, we still remain very much under the influence of what this pandemic is doing in the country. We've now exceeded 5 million cases. We've got 162,000 deaths. We're still losing anywhere between 500 and 1,000 people a day. Some of the estimates now are we're going to approach 300,000 deaths in total by year's end. There is a little bit of good news that the infection rates in some of the southern parts of the country, which had been ballooning back in July and late June, now those rates of infection appear to be declining a little bit. So maybe the very worst is behind us in parts of Texas and other parts of the Southeast. But as you can see, this problem still remains out there. But probably the bigger issue is what we're dealing with regarding the economy. And this is a map that's showing continuing claims and where people are asking for claims by percentage around the country. And for the most part, you can see that almost every state is looking at an orange or a dark orange. And so the key takeaway here is that we are still in a very, very difficult situation economically. We have millions of people unemployed. But we did get a decent number in terms of the unemployment number last week, which was we're now at 10% or 10.2% unemployment. That's an improvement from the 11.1% unemployment rate we had at the end of June. So we are moving in the right direction, but some of the concerns out there is that we're not creating jobs as quickly as we were hoping. The idea was that we were losing tens of millions of jobs back in late March, early April, as restaurants and retail stores were forced to shut down. The hope was that once everything opened up again, that these jobs would all be rehired and everyone would get back to work. And what we're seeing is that things have reopened, but not everybody's getting back to work. And I think what we're seeing in some of the numbers that we're getting from Wall Street this week are definitely a mixed bag. The Wall Street numbers for the NASDAQ, the S&P 500, even the Dow, are either in record territory or very close to getting back to records that we had prior to the pandemic. And one would have to ask, well, how can it be that the stock market is up so much when we've got all this unemployment out there? And unfortunately, they're directly related, that companies have been reporting earnings over the last couple of weeks. Earnings are coming in much better than what people had been expecting. Businesses have been cutting expenses dramatically. They've been saving a fortune on office space and business travel. All of that's been saving companies a lot of money. And what we're concerned about now is that whether all these furloughed workers are now going to become permanent layoffs. And that's sort of what we're looking at here over the course of the fall. And that's kind of the next shoe to drop here as we're watching what's going on with the economy. What does this recovery look like? Well, the Wall Street Journal put out a survey back in June asking economists what they thought the recovery was going to look like. And you can see the vast majority of people are expecting a Nike swoosh type of recovery. And we're essentially above the bottom now, sort of on the getting onto the upswing, but we've got a long way to go. That swoosh has a long tail. And it's going to take us years to get back to the levels of vehicle sales that we had prior coming into this year. The other possibility is that we do have a W type of recession. And there's a lot of folks, and I think that in general, there's some feeling that this may be rising in terms of its likelihood, that we're going to see another resurgence of this virus come late fall, early winter, as we all move indoors, and that's going to cause another hiccup here in the recovery that was going to force more closures again, that may lead to another economic pullback. Certainly, we hope that none of those things are going to happen. But I will say, I think the likelihood of the V-shaped recovery is falling by the day. It just seems very unlikely that we're going to see this economy bounce back as quickly and as aggressively as we all had hoped for. This is going to be a long recovery period. I think the more we get used to that idea, the better off we're going to be. Now, one of the things that we do watch closely is what consumers are saying out there. And we get data from Morning Consult. They survey thousands of people every day, asking them all types of questions. But one of them is, what is your overall optimism on the economy? And what we can see is that we fell dramatically in the early days of the downturn. We bottomed on this metric the end of March, early April, and then we've made a very slight but consistent but very slight recovery from that. And I think one of the things that's emerging is that we're starting to see a new equilibrium or a new plateau where we're sort of at 80% of our normal. That 80% is becoming the new threshold, and that we're essentially down about 23% from where we were prior to the pandemic. We're seeing a lot of metrics out there where you can see that the volatility appears to be subsiding a bit, but we're settling at a lower level. And that's the real concern, is this the new normal? Is this economy no longer a 100% economy? Everyone's got to adjust for an 80% economy. And that means that there's a lot of white collar jobs out there that, initially we're planning that, we'll get these people back to work, that maybe we're not going to have need for them at this point. So again, that's one of the concerns that we're watching out there. But certainly consumer sentiment is going to be critical to getting this vehicle market back. Very few folks are going to be out buying a vehicle that don't feel confident about their economic situation, and certainly that don't feel confident about where this overall economy is headed. But we do other surveys as well at Cox, and some of the results that we're getting back are showing a little bit of a change in the mood out there. We do a survey of folks, and we ask them, when do you think you're going to be in the market to purchase a vehicle? And the number of folks that are going to be buying a vehicle within the next 6 months has been dropping from where it was prior to the pandemic to where it is today. We were at 20%, now we're at about 15%. Not a massive decline, but that's 25% of folks who said that they were going to buy a vehicle within the next 6 months. So that's a large portion of people that are out of the market now. And that's concerning. And it's not surprising. I mean, of course, you wouldn't expect people to think that now is a particularly good time to go out and buy a vehicle. But it does suggest that, and you can see the numbers here, that as the longer we are in this COVID period, it continues to weigh on people's outlook and their willingness to buy. And that means that it's going to be slow going here on vehicle sales for the remainder of the year. And people are asked, are you going to be delaying your purchase? And what we can see here is that in the early days of the outbreak, only 17% of people that were going to purchase are now saying they're going to delay. We peaked at 34% during the worst of the crisis in mid-April, and we've improved slightly from then. But we're still close to about 30% of folks saying that they're going to delay their purchase. And why are they going to delay? Well, the vast majority, 55%, are saying this is an uncertain time to buy a vehicle. Well, it's hard to argue with that. I mean, it's definitely unprecedented territory that we're in right now. But there's still a large portion of shoppers out there that are not delaying, and they think it's a good time to buy. And I think that that's something to really keep in mind as you think about your own business, that there are all kinds of consumers and buyers, there always has been, but we also have two types of buyers in the marketplace today, and it's those that are really concerned about this virus and folks that are not that concerned about this virus. But at a minimum, I think that it's wise to take the safe approach and assume safety, run your business such that you're being COVID compliant, because you don't want to scare off folks that are worried about this virus and make them unwilling to want to come in and shop. That I think if you're given a choice, it's probably better to err on the side of safety. I can tell you from my own personal experience, I was in a dealership last week, and nobody in there had a mask on. And I can tell you in Michigan, that's very faux pas in some parts of the state. And it really makes you uncomfortable when you're in that environment to see all these people with no masks on, like, don't they know what's going on out there? And I would just suggest you really think about that and what you're presenting to customers when they're shopping. But what we know is that the customer base is varied, but there is concern out there. And when of those people who are going to delay, we asked them, how long are you going to delay? And we did see a big jump in the number in July. In July, we had about 30% of the folks saying that they were only going to delay for 2 months. 47% earlier in July had said that they were only going to delay for 2 months. But you can see that now that number has kind of switched, and the big portion now is that 46% are saying they're going to delay their purchase for 3 to 6 months. And that's up substantially from what it was the previous time we measured. So the mood out there does suggest that consumers may be getting a little bit more sensitive to the situation that they're in and a little bit more conservative on their spending. And I think one of the things that they're going to be dealing with is those that do come out and shop, they may be in for quite a rude awakening. Because we ask people that those in market remain confident that they're going to get a great deal on a vehicle. 86% of respondents thought that they're going to think it's going to have no problem finding the exact vehicle that they want on a dealer's lot. And another 84% are expecting that they're going to get some kind of a deal or favorable term. Well, I can tell you both of those numbers are not in line with what the reality is out there on the street. And I'll show you a few slides on this in a moment, but inventories remain very, very thin. The ability to get the exact color you want, the exact trim level you want, may be a real challenge for some buyers out there. And of course, getting favorable terms, everyone thinks, oh, it's a recession, there must be fantastic deals out there. Well, the fact that inventory is so thin means that the manufacturers don't have to be that aggressive on their deals, and the dealers don't have to be as aggressive to move the metal. I think shoppers out there may be in for a rude awakening when they start showing up on dealer lots. And the other reason why, as I said, is that there may not be these great deals is that the industry has really backed away on these 0% financing offers. This is a chart that's showing the percentage vehicle purchases that are getting a 0% financing rate. And you can see that there was a big spike in the depths of this crisis in late March, early April. A lot of manufacturers moved to long-term, 60-month, 72-month, even 84-month terms with 0% financing. We saw a lot of products that went that way. And I think that was a big contributing factor in the early days of the recovery, of spurring a lot of interest from consumers, of folks that were looking for that deal, even in the depths of a pandemic. So what we've seen since then is the industry has backed off from these financing offers, and there's just not as many out there. So for those consumers that are expecting that there's still a great deal to be had, they may have a hard time finding that. So just looking at what we're seeing about vehicle sales out there, we have the ability at Cox where we can track retail sales for the new and used market on a daily basis. And so we do a comparison of same store, same day on a year-over-year basis to really try and get a gauge where the market is at. And what we can see here is that the market fell dramatically in March and really reached bottom at the very beginning of April before it started the recovery. But we can see the used market has recovered much more quickly than the new market. And we estimate year to date, and this is just retail sales, used retail sales, so none of the Facebook or Craigslist activity, because we don't have a good measure for that, but just what's being sold at dealers. We estimate that the used market's down about 5% year to date. However, the new market, just new retail, so not including fleet, we estimate that's still down about 19% year to date. You can see that the used market has really come back much more aggressively. And that's not surprising. There's a much lower price point in the used market, certainly many more low price options to choose from. So that's not surprising. But as you can see, the most recent data points is showing quite a bit of volatility in the used market. And I'll show you in just a minute that the used market is getting very, very tight on inventory. And so it may be that we actually start to see the used market, the recovery is really going to start to stall here in the next couple months because of this low supply issue. And I'll show you more of that in just a moment. So let's just quickly review what happened in 2020. And I've updated these slides. I've shared some of them with you before, but I thought it was worth to kind of update them. Here's what we're seeing for the new monthly sales SAR. We finished the month of July with a selling rate of 14.5 million. The market finished down about 12% from where we were in July of 2019. That's pretty good. 12% decline in the depths of this pandemic, I think we'll take that. But I think we had an interesting change in the market in July, which was the return of fleet activity. We saw quite a bit more fleet activity, both commercial as well as rental car, in the month of July. And so that's kind of lifted the market a little bit more than I think what many analysts, including myself, were expecting for the month. So that's a good sign to see that the fleet market may be coming back a little bit earlier than most of us had expected. But we are still in a situation where the market is depressed, and there's very little reason to expect to see a lift in sales really beyond what we have right here today. The other interesting thing to point out is that car share had been declining through this pandemic, but actually took an uptick in July. And part of that may be the fact that that's the inventory that's available out there because of the supply constraint that if you want to get a new car, that may be the only option that you've got out there. But when we look at sort of the year-to-date impact by brand, we can see that the market overall, and this is looking at total sales, we can see that the market's down about 22%, so that includes retail and fleet, but it varies dramatically for the different brands out there. And Fiat and Dodge and Nissan, they're all down substantially more than the national average. And we can see on the other end that Lincoln, Mazda, and of course Tesla, which is a little bit of an anomaly because they don't do the dealership distribution model, they seem to be doing relatively well. And I think one of the things that we're seeing in the data is that new products can really help your situation. Certainly that's been a big lift for Kia and Hyundai because they have some relatively new SUV products, and Nissan, which has a relatively old portfolio, so their vehicle sales have been hit rather hard. And those companies that engage in a lot of fleet activity have been hit particularly hard. And I think Nissan is certainly a good example of that in terms of doing a large volume of fleet. But I think we have to be careful not to read too much into these year-to-date numbers because a lot of the moving parts out there were really out of the control of the manufacturers because these states were opening and closing based on what the governors were demanding of people. So often they weren't able to sell even though they wanted to. And as a result of these changes in selling rates, we've seen big changes in terms of market share. And then we can see that Nissan, that loss of fleet activity has really hit them hard. They've lost close to 1.6% of market share looking at the first 7 months of this year versus last year. At the other end, you can see that Kia and Chevrolet are both actually doing relatively well. They're actually gaining share. Kia, much on the back of their hot-selling Telluride, and certainly Chevrolet from a lot of those aggressive truck financing offers that they had back in April and May, I think really was a big boost to their vehicle sales. So the situation's been very volatile out there and things are changing, but as I explained before, I think in another presentation, a lot of it has to do with just the fact of states opening and closing around the country is really making it difficult to do any kind of a sound, fair evaluation as to how all the different manufacturers are behaving and how well they've been selling here in the last few months. This is a chart that's showing a map of the United States and the year-over-year change during the worst of this pandemic, so March 1st to April 30th. And nationally, during that period, retail sales fell 45% across the nation. But it varies dramatically in different states. You can see that Pennsylvania is sort of the big loser, if you will, and they fell 72% during this period. New York fell 63%. California, 56%. That's certainly three of the largest markets out there. Texas was sort of middle ground. They fell about 31%. And the big winners in this situation, if you had to pick one, would be Arkansas, which fell only 12%. And what we know is that Pennsylvania's governor shut down their state rather early. And so dealers weren't even able to sell during the depths of the pandemic. However, in Arkansas, they never shut down the economy. Everything was open all the way through. And so if you had to get an idea of how much of the decline in sales is due to dealer closings and government activities, Pennsylvania, 72% might be a good number to kind of gauge the impact of shutting the doors. If you wanted just sort of the consumer confidence and the shock of it all with no real government response, Arkansas kind of gives you an idea of how the market maybe would respond without the closures out there. But certainly the winners and losers is changing rapidly just based on these states opening and closing. And in terms of the impact on share of market, we get the outcome that we would expect. Pennsylvania lost 2.2% share of overall sales during this period. New York and California down about 2%. The winners, who's gaining those sales? Well, Florida gained about 1.3%, but Texas was really the big winner. They gained 2.4% market share during this period because they were open for business, and they're also a big heavy truck market. And as I said, that we know those pickup trucks have been selling well, at least in the early days of the pandemic, and that helped lift Texas's situation. But then we entered into the recovery phase. And if we look at May 1st through June 15th, sort of the early days of the recovery, we can see that a lot of the ground lost was regained rather quickly. And that by reopening these dealerships around the country, as well as the pandemic starting to get more of a problem in southeastern states, we can see the situation changed rapidly and reversed itself. That Pennsylvania regained 2.1% of market share. California regained 1.6% of market share, while Texas and Florida both lost, a little bit over 1.5%. So it's been a very volatile marketplace out there. And so I would suggest that if you even evaluate your own selling situation, much of it, I think it's fair to say, has been out of your own control. So if we look at how state sales have been year to date, as I said, the nation is down, and this is looking at just retail sales because that's where I have the ability here, was down in the middle. But in general, I think we can say that the early COVID states, California, Michigan, New York, the East Coast, the Pacific Coast, they got hit fairly hard, while the southeastern states, which remained open and weren't quite as hit as early with this pandemic, have done relatively better so far. I'm going to skip this one because I actually have the slide for mini, so I don't know that you guys necessarily need to see that. But let's jump into what we're expecting to happen next. And I've showed this slide before, but I think it's worth revisiting because I really think we're starting to see some of this happening in the marketplace. And this is really just a grid to try and capture what consumers are seeing out there in the marketplace. And they're going to be looking at vehicle prices. And what we expect is that those manufacturers that are offering products that are very high priced are going to be in a very difficult situation because consumers are going to be seeking value. They're going to be seeking lower prices. They're going to be seeking ways to mitigate their exposure to this uncertainty in the economy. And that would suggest that they're not going to want to buy the most expensive thing out there, that they're going to pull back in the marketplace a little bit. And even the more expensive products within some of the brands that have, in general, a lower average price, even those more expensive products may be under threat. So we expect consumers to be moving towards the left, looking for lower prices to lower their cost exposures. But we also know that credit availability is going to become an important part of this recovery, and who can and can't get approved for credit. And what I have here on the left axis is the average interest rate that the consumer signed up for when they made their purchase. And this is 2019 data. And if we can use the interest rate as a proxy measure of FICO score, so the higher interest rate you're paying, the lower your FICO score probably is, it reveals a bit about who are the types of customers these different brands have. And we can see that Mitsubishi has some of the lowest priced products in the market, but they also attract customers with the worst credit scores. And as we look in this environment today, one of the things that we know is that the workers that have been lost so far, the jobs, the vast majority have been hourly workers. Folks at the lower income scale, below $40,000 a year income. Well, in general, those are the folks with relatively low FICO scores. So it may be that certain brands like Mitsubishi and Nissan and Kia and Fiat, even though they have relatively inexpensive brands in the products in the marketplace, their customers may not be able to get credit because they have relatively low FICO scores, or they may be folks that have actually been hit pretty hard by this recession so far, and so they've lost jobs versus those with the higher incomes may actually be okay because they haven't lost jobs so far. The Federal Reserve Chairman said a few months back that in the early days of the pandemic, when we had all of the initial job losses, that the unemployment rate for households with incomes of $40,000 a year or less was 40%. The unemployment rate for households with $100,000 a year or more was only 13%. So this recession is hitting lower incomes and not necessarily higher incomes. So that may mean even though brands that have lower cost products may not necessarily be benefiting from that because their customers are particularly vulnerable. So it's just something to keep in mind. And then just looking at the same analysis by different segments, we would expect that the luxury segments, the performance segments to do relatively poorly because people aren't looking for the living large type vehicles right now. But at the other end of the spectrum, we would expect subcompact cars, compact cars to do relatively well because they're the cheapest products in the marketplace. But as I said before, they also attract customers that have the worst FICO scores. And so those folks may be getting wiped out by this recession and may have a hard time getting credit. So again, just something to keep in mind as you look at what your product portfolios are out there. And some of the longer term trends that we see happening, though, is that the new market has really been abandoning the lower priced products for quite some time, and it makes the industry particularly vulnerable in this recession. This is a chart that's showing market share by different price groups. And in 2012, 54% of the new vehicle market sales were for products priced less than $30,000. By 2019, only 27%, so half, cut in half, of vehicles sold have a price point less than $30,000. And you can see in 2020, in the depths of this recession, it's actually gone down further, that we're even attracting even fewer buyers of the lower priced products here in the new vehicle market. And what's interesting is at the other end of the spectrum is the more expensive products, those over $50,000. Just 6% of the market in 2012 was these high priced products. By 2019, it's 26%. So we've seen a big jump in these higher priced products. So far in 2020, well, it's down a little bit, but it's holding up there pretty well, I'd have to say, given the magnitude of the downturn that we're dealing with. And so I think one of the interesting things that we're seeing out there is that the vehicle buyers that are in the marketplace today are the highest incomes, or probably the most choice customers that we could possibly have, because a lot of the questionable buyers, the lower credit score buyers, have really been forced to leave the marketplace and are probably ending up in the new market, and is contributing to that recovery that we're seeing there. What does all this mean? Well, we know that monthly payments are already high, but just to give you an idea as to what we're talking about in terms of money, a 5-year loan at 4% for $25,000 is $460 a month. $50,000 is $920. So folks in a recession are looking ways to save money. That $50,000 price point does suggest that it's going to be a very slim pickings to find those customers in this environment. And just looking at some of the sales that we've seen year to date, if we look at year to date sales by some of these different price groups, we can see that those vehicles priced below $20,000, their sales year to date are actually down 50%. And those priced in the $20,000 to $30,000 range are down about 35%. Interestingly, more expensive products, like in the $50,000 or $60,000 price range, are essentially flat year over year. And even in the $30,000 to $40,000 price range, it's doing better than the national average. And so we are seeing, as I said, I think a bit of a weeding out as to who's actually in the marketplace to buy vehicles today. And we only have the higher incomes remaining, which is why we're seeing these higher priced products actually do relatively well. In terms of price strength, this is a measure that I use to look at, what percent of MSRP is the transaction price. And if you didn't have to do any discounts or incentives, you'd have 100%, that you're paying whatever the MSRP is. But we know that there's always some sort of a discount. But what we can see here is that so far in 2020, that vehicle prices have actually held up fairly well, that a transaction price as a share of MSRP has actually improved this year over last year, which suggests that there are incentives out there, but the industry has not been particularly aggressive in chasing after this sales volume. It actually has been fairly disciplined so far. So just looking at the status of the markets, what we can see here on the left, this is rolling 30-day sales for both the new and used market. A little bit different than that chart I showed you a couple slides back. But really the key takeaway here is you can see that the nice V recovery that we've had in the used market and the similar V shape that we've had in the darker blue new market. But what we can see is that the new market is improving, but it's still well below where we were at a year ago. It's more in the neighborhood of where we were at in January, sort of where the new market is today. And if we look at the year-over-year change on the right, you can see that we've seen a nice recovery, but that the used market continues to be running essentially ahead of where it was at this point last year, while the new market continues to struggle. But it's that recovery that we've seen in the new market, as weak as it may be, it's actually recovering a little bit more quickly than supply is. And that's changing the dynamics of the available inventory out there in the marketplace. This is looking at new vehicle inventory. And on the left, this is the available supply that we're able to measure here at Cox Automotive. And you can see that it's far below the levels we were at a year ago. We're looking at, essentially 2.4 million available supply. Very, very slim supply out there. And what's important, though, is how long will this supply last? And that's what days of supply is. So based on your most recent sales over the last 30 days, how long will your current inventory last? And what you can see is the day supply spiked during the depths of this crisis when we saw demand really pull back significantly from all the shutdowns around the country. But then it reversed itself and has really improved dramatically as demand has been picking up. So that now that day supply is approaching 60 days, a low that we haven't seen over the last year. So supply is getting tighter out there. And the other interesting thing is the type of supply that we have. The industry is way behind our normal model year rollover schedule that we sort of follow in the August, September, October timeframe every year. This is the period where we want to get rid of the old models, so we clear off the shelves. We want to get ready for the next model year so that we can price those at a premium. But what we know so far this year is that the number of vehicles that are the old model year, and that's what's in red here, we can see that there's more old models in the supply right now than there was at this same week last year. We have about 1.9% of the models last year was model year 2018. This year it's 3.1% is 2019. So we have more of the old product on the shelf. But I think even the more interesting number is the lack of new product that we have. Last year at this point in time, almost 8% of dealer inventory was model year 2020. This year, only 0.5% of inventory is model year 2021. So we're way behind in the sellover period. And I think it's really only two vehicles out there that we're seeing 2021 inventory. The Kia Soltis, I think it is, as well as the Chevy Trailblazer. But other than that, we haven't seen a lot of new product introductions. So that means this fall, consumers that may be shopping, waiting to get the latest products, are going to be in for a surprise because the latest products just aren't out there. And then just looking at the inventory situation for different manufacturers, we can see that Subaru and Toyota are in a very tight inventory situation. They have less than 40 days supply. We're hearing some stories anecdotally from dealers around the country that they're saying, why should I even open up this weekend? I got nothing to sell. So they're in a very tight supply situation. But you can see Mitsubishi, Fiat, the other manufacturers are in a very different situation where they still have a tremendous amount of inventory given their slow selling rates. And then just in terms of the model year rollover question, we can see that it varies quite greatly in terms of who's got old product and who doesn't. Fiat has a tremendous amount, in fact, the vast majority within the old model year here, or at least leads the pack, versus other companies like Subaru and Toyota are in a very strong situation. We don't have a lot of old inventory. And as you can see, the next year inventory coming out, there's really only two companies that have bothered to put anything out there just yet. And we just look at the luxury side. Again, in general, luxury is running about 6-7 days more supply than we see in the broader market. But again, it varies tremendously by manufacturer. Lexus appears to be in the tightest situation, with Buick on the other end as to having much higher inventory levels. But you can see on the right here who's vulnerable to old model year share. Well, Alfa Romeo, 16% of their inventory is model year 2019. That's getting pretty long in the tooth as we're getting here entering into the fall. So I wouldn't be surprised to see some aggressive activity to try and get rid of those products. And there's no one yet, and I'm sure this will be coming here in the next couple of weeks, but nobody yet who's got model year 2021s out there in the marketplace. But as I mentioned before, what's really interesting is the used vehicle market, because that situation is really changing quite quickly and is getting very, very tight. And what we can see here on the left, this is rolling 30-day sales, the nice V-shaped recovery. The used market has been particularly hot. I think, and I don't have the data yet to support this necessarily, but I will suggest that the fact that the new market has abandoned, or at least has pulled back significantly on that less than $30,000 price point, is really pushing people into the used market. Because if I have a limited budget, I don't want to spend a lot of money, don't have a lot to choose from on the new side, because there aren't a lot of products there to choose from. But there's a whole heck of a lot of products I can choose from in the used market for less than $30,000, and certainly a whole bunch of leather-bound, moonroof, nav system SUVs that I would never be able to come close to affording in the new market. But what's interesting as we look at rolling 30-day sales is on the right is the change in sales. And in red is the year-over-year change, and in blue is the versus the previous week. And the real key takeaway I wanted you to have on this slide is that we had the nice V-shaped recovery from where we were a year ago. Sales look relatively strong, but the pace of that change is now starting to wane. And you can see that we've had this tremendous boom in used vehicle sales, but the pace of that boom is now starting to decline. And I think much of that can be attributed to two factors. One, that the Paycheck Protection Act that came out back in March and early April, well, that money has been spent, and it happened months ago. So sort of the sugar high that we were going to get from that government bailout has sort of been spent. So we don't have a lot of that. But the other thing I think that's really impacting the pace here is the fact that inventory levels are getting very, very low. So here's available supply looking at the used vehicle market. And you can see that available supply has just fallen dramatically. It's now below 2.2 million. We don't have a long history with this data, but it's far below the data we have going back a year and a half. And it's really not surprising. We know that the fact that folks are pulling back from the marketplace means there's going to be less trade-ins. So we don't have that trade-in activity. We also are a few years past our peak in the new market, right? It was 2015 and 2016 that we hit 17.5 million. Well, since that time, we've sold hundreds of thousands of less. And there's about a 3-year delay of a new vehicle getting into the used market, sort of that off lease. And so there's just less new vehicles to spill into the new market as we keep going forward. And of course, the other issue, which I think could reverse itself here in the fall, is that we did have a moratorium on a lot of these foreclosures, as well as defaults on loans or evictions. Everybody was kind of given a pass for a few months to get through this virus. Well, now a lot of those protections are expiring. The extra money that people were getting for their unemployment has expired. Congress hasn't approved anything yet. And I did just see actually a report that was saying in the month of July, 33% of people making a mortgage payment could not make that payment in July, 33%. So the situation on repossessions of vehicles may change itself this fall. Repos have been relatively low in recent months, but we could see a surge this fall as more and more folks have a hard time making that car payment. That certainly would help lift supply to the used market. But beyond that, it's hard to see anything else that's really going to reverse the course that we're on. And just looking at the change in supply, in red, it's versus a year ago. In blue, it's versus last week, or a week-over-week change. You can see that the supply just continues to fall. And as I said, there's little reason to expect that to change itself here anytime over the near future. I don't know what's going on with that chart there while that's happening, but those are just dates, the same as you see there on the left. So as a result of this tight market that we're seeing in the used side, vehicle prices at auction have actually been rising quite dramatically. And this is a chart that's showing the Manheim auction, Manheim index that goes back to 1997. And in April, we had the biggest decline in history. And then in May, June, July, we had the biggest increases in history. And so we've seen 3 straight months of double-digit increases in the used market, excess of 5% at least in the used market. These are really fast gains that we're seeing out there. And I think what we're seeing is the tight supply in the marketplace is starting to spill out into the auctions. And that strong demand and limited supply does create an inflationary environment. And we're still in the early stage, but I just wonder if this isn't a long-term trend that we're going to see for quite some time. Because when you think going forward, what does the used market look like over the next couple of years? Well, we know there's not going to be a lot of fleet volume coming into the used market in 2022, 2023 because of the big pullback in fleet this year. We know there's not going to be a lot of lease activity coming in because of the big pullback in vehicle sales this year. And of course, just the overall sales itself falling at least 20% this year means there's just going to be less volume available to the used market over the next 2, 3, 4 years. So it could be that right as the economy is starting its economic rebound, hopefully tomorrow, but let's just say it's 2, 3 years from now that it really starts to get going. It's going to happen right at a time when the supply to the used market is going to be particularly tight. So I just wonder whether we're looking at sort of longer term inflationary aspects here in the used market. And just to reiterate that point as well, this is showing the wholesale and retail price indexes for a 3-year-old vehicle in the marketplace. And we can see that in gray here, the solid gray, in the depths of this crisis, we saw that there was a lot of concern at the wholesale market that all these vehicles were building up at auction, they weren't selling, the prices were going to collapse. And that was the real concern, as if you may remember a couple slides ago, and the big spikes in day supply that we saw. But all of that was temporary. And once these dealerships started to reopen and the states reopened and people got those bailout checks, we saw those vehicles sell quickly. And what we can see now is that vehicle prices in the wholesale and retail market are running ahead of where they are last year. So there's definitely a lot of inflationary pressure out there in the marketplace. And just thinking for a bit about the CPO market, CPO has actually been making a nice recovery as well. And I think CPO is going to be a compelling story here in the marketplace for the foreseeable future because it's sort of the best of both worlds. You're getting the guarantee of a sound vehicle with no exposure, warranty issues that you have to worry about because you're covered, and you're getting a massive discount on the vehicle. So in this environment, I think it's a particularly compelling offer for vehicle shoppers. We can see that the CPO market has recovered quite nicely. We're expecting CPO to do about 2.5 million vehicles this year, just down a few 100,000 from where we were last year. And when we think about who the big players are in the CPO market, well, Toyota is clearly the big player. They've got the largest market share so far in 2020, but Honda and Chevy aren't too far behind. But I just think just keep your eye on CPO, or certainly these gently used vehicles in general, because I do think that this is going to be a sweet spot in the marketplace for consumers, and yet dealers are not going to be able to get their hands on these vehicles. It's going to be a real challenge out there as supply continues to get tight. But there will be ongoing supply of these. I think I've shown you this slide before, but just to kind of reiterate, this is our tracking of expiring leases in 2020. Here's your guaranteed demand. We know that these folks are going to need transportation, that they're going to turn in their old vehicle. They're going to want to buy something new. So this is going to provide demand for the new market as well as supply for the used market. And we're expecting about 4.1 million off lease this year, about 340,000 a month. These are the choice customers out there. They're coming back every month. We do know that there was a bit of a delay in the early days of the pandemic when manufacturers did not want these vehicles to get turned in. They were asking folks to just stay in their vehicles a little longer. But we've moved past that phase. And so we can expect that these vehicles are going to continue, and buyers are going to continue to come back to the market through the remainder of the year. These are your choice customers. 800 FICO scores or your best FICO scores. It's going to be very competitive for them. a lot of lease loyalty programs, a lot of conquest programs going after these customers. So it's just something to be aware of. And the luxury market as well. We're expecting about 1.1 million off-lease luxury vehicles this year. Well, that's 1.1 million folks that are going to need to get new wheels. So again, that's your sort of base demand that we have out there, as well as supply to the used market, about 90,000 per month. So yeah, the interesting thing though is this is what we're expecting in 2020. If you look to 2021, it's going to look very similar. So these are from vehicles 2018. The vast majority, the sales activity we did then, but that was a good year. We're going to have 4 million plus or minus off-lease vehicles coming back next year as well. So there is going to be supply, but it is going to be limited, and it's going to be very competitive to get these customers as well as to get those turned-in vehicles. So with that, those are my comments for today. In general, I would just say, the recovery continues, but we are starting to see some headwinds, and certainly this limited supply in both the new and used market is just going to add one more challenge to the marketplace on top of finding customers that are actually willing to be out there in the marketplace to buy. So any questions I can address or any comments from folks?
If anyone has any questions or would like to get in touch with Charlie, you can email me and I will pass them along. Charlie, thanks so much for speaking with us today. This is really important information and we appreciate you coming back each month to keep us updated. Again, to those on the line, you'll be receiving a recording of this webinar by the end of the week. Be sure to join us back here on Thursday, yes, this Thursday, August 13th at 2 p.m. Eastern, as experts from Fisher & Phillips help us navigate what to do if one of your employees tests positive for COVID-19. So be on the lookout for promotions on how to register. For more information about AIADA, visit aiada.org. Thanks for joining us and have a great day.